The extra space in your backyard is not just dirt and grass. You're sitting on a gold mine. You've got the potential to earn thousands of additional rental income and cash flow by building an ADU, a garden suite, or a laneway home. With the enhanced Build 23 municipality initiative, it is easier now for you to build such units. And also with available grants, it has become more affordable. So right now is an excellent time. The biggest hurdle, however, remains as financing. How do you build these units? In this video, we're going to cut through any confusion. I'm going to give you a step-by-step guide on how to finance these units, from acquiring a site to financing the build. And I'm going to also help you ask the right questions that will save you thousands of dollars. So let's get started. Before we get into the specifics of the loan options available to you to finance a garden suite or an ADU or a laneway home, I want to share with you the 4 fundamental building blocks of financing projects like these. It's important for you to know what they are and to get clarity going into the deal from the get-go. So here are the questions. The first one is about financing the build itself. Sometimes you own the property and you want to add to an existing property, and sometimes you're looking to acquire a new property that has the potential of adding an ADU or a laneway or a garden suite. So over here, we want to explore the different loan options available to you, and we want to understand what percentage of the actual build you will be able to get in a loan and what is it going to cost you. So we're going to drill into that shortly. Number 2 is about your ability to refinance once the work is done. By adding an extra unit to the site, you're essentially increasing the value of the real estate and you're adding additional rental income. And as a real estate investor, you may want to take money out at the higher value to continue to grow your portfolio. So the question here is, how soon can you do that? And what loan options are available to you? And we're also going to drill into that. Number 3 are the carrying costs of the loan. Depending on the type of loan you take, there will be costs beyond just the interest rate. The interest rate is one aspect of the cost, but we want to go in with a fine-tooth comb to understand everything related to the cost of that loan, from lender fees, broker fees, interest reserves, renewal fees, administrative fees. So you need to know going in, what does that look like? And lastly, what I call leverage alignment, which really about making sure that whatever loan you're gonna take going into the project, it is aligned with how you intend to run the project. So if it's going to take you 6 months, does that loan support that timeline? Or will it be expensive to break it if you finish in 6 months? If you need a year, will the loan allow you to deal with longer timelines? We need to make sure that whatever option you're going into aligns with your execution strategy. So we're going to drill into all of these fundamental building blocks, and we're going to talk about the loan options available to you. Let's talk about the financing options available to you to finance the build of an ADU or a garden suite or a laneway home. Let's start with a scenario where you own the property and you've got enough space in the backyard to build 1 unit, 2 units, or potentially 3 units, with the ultimate number of units on the site being a maximum of 4 residential units. Before we get into the options available to you, if you own a property and you're looking to build and that property already has a first mortgage on it, it is important not to demolish the asset and start building without setting up the appropriate loan. Because you don't want to be in a situation where the lender that currently holds the mortgage on the property learns that you've demolished the asset where their loan is secured, that's going to cause problems and they can recall the loan. So if you currently own the property and you're not planning on demolishing the existing asset on the property, then here are the 4 options available to you to finance the build of additional units. The first option is to see if you have equity available to you in the existing property. So you may have a first mortgage, but if that property's got equity in it and you qualify to pull some money out, the best way to pull that money out is to set up a secured line of credit, assuming that you qualify. Between the first mortgage and this secured line of credit, with traditional lenders, you can get up to 80% of the value of the home. So if there is enough money to pull through a secured line of credit to finance the build of the unit, that would be your cheapest option. Why? Because the interest is going to be competitive. The money is available to you when you need it. You use it as you need it. You're not paying principal and interest on this money from the get-go. And typically line of credits come with no fees. There wouldn't be lender fees or broker fees on line of credit. So that is your cheapest option. If you're able to pull money from the property itself to finance the build, that's your fastest and cheapest option. Option number 2 is to still look at what is possible here and to also see what are the possibilities within your existing real estate portfolio. If you've got other properties within your real estate portfolio that have equity in them, if you're able to set up a secured line of credit where possible on these properties and they all add up to cover the cost of the build, then that is your second cheapest option. The third option is to consider a private mortgage, either on the property itself or a combination of the property itself and other properties within your portfolio. I would go to a private loan only if there is no cheap way to get money out of your portfolio to finance the build. But when it comes to private money, we need to be careful about the costs associated with private money. It is a good option to use if the costs make sense for how long it's going to take you to build. So if your build is going to take 3 months or 6 months and we're getting a private mortgage, you're incurring these costs over a short time period and you will be paying off this loan once the work is done. But if it's going to take you a longer time frame, then we have to see if a private loan makes sense. Private loans come in with a higher interest rate. They typically come in with lender fees that range anywhere from 1 to potentially 3 or 4%, and they come in with broker fees. But they do offer you the opportunity to tap into equity that you may not have been able to access through traditional lenders. It's a faster type of money because the documents required to qualify are not as intensive as the documentation and qualification with banks and traditional lenders. And we just got to make sure that it makes sense for you. All right. So that's option number 3. Option number 4 is construction financing. And I'd like to show you when to use this option and also help you understand what comes with construction financing in terms of fine print. If as part of your project you are planning on demolishing the existing house that has a mortgage on it, then I highly recommend that you take the construction financing route, because as part of the construction loan, they will pay off this first mortgage and give you money to start the build. Do not keep the first mortgage in place if you're going to demolish the current asset. Hey everyone, we're going to be going back to the episode shortly. I just wanted to give you access to a complimentary 1-hour training that I've put together with a veteran real estate investor who focuses on ADUs. He's literally done hundreds of them. And in this training, we are diving deep into the strategy itself, what you need to plan for, how the numbers look like from an investor standpoint, as well as financing. taking a deeper dive into all of the financing options I'm talking about in this video, along with the numbers. If you would like to get complimentary access to this training, you can scan the QR code in this video or look for the link in the description of the video. Now back to the episode. A construction loan is your last resort if you cannot finance the deal through cheaper methods. Why? Because with construction, there are administrative burdens, such as dealing with the lender for draws to finance the project, reporting back to the lender as you make progress, and they are generally more expensive. So let's take a look at an example. Let's say you currently own the site and there is a house on the site, and that house is worth $750,000, and it's got a first mortgage of $550,000. And let's say that is going to cost you $300,000 to build, and you anticipate the value after you add the extra unit on the site for the entire site to be higher at $1.2 million. So how would a construction budget work in this case? Here is generally how the lenders look at this. And again, every scenario is different, but I want to share with you a typical example. Lenders will look at the ask complete value of $1.2 million. And lenders on the street generally would say, you know what, I'm going to give you a loan as long as it does not exceed a percentage of this ask complete value. So some lenders will go at, anywhere from 65% of the ask complete value to 80% of the ask complete value. And let's say we're working with a lender that is willing to go up to 80% of the ask complete value. So that number is $900,000 loan that they're willing to give you in order to get your project done. Construction loans come in two components. There is component number one and component number two. Component number one of this $900,000 is going to be a loan to pay off this first mortgage that you've got on the property and to cover any fees associated with this loan. And typically you're looking at lender fees that range anywhere from 2 to potentially 4% on the expensive side on a construction loan. Brokers as well charge a fee. And there is interest on these loans. And the interest on a construction loan is typically anywhere from prime plus 2 to prime plus 4 sometimes. So we're talking about the prime rate at that point of time plus 2 to potentially plus 4. They are interest-only loans. So we're getting a $900,000. There is a lender fee. There is potentially a broker fee. There is going to be interest on this loan. And let's say it's going to take you 6 months to build. So what lenders do as part of this first component of the loan is they say, okay, how much is it going to cost in interest on this loan? And some of them will deduct that interest upfront. They're not going to let you pay that interest on a monthly basis, okay? And some of them are more lenient. They are not deducting interest. If you've got an existing property that's going to generate rental income, they may not deduct the interest upfront, but I just want you to be aware of the different setups: lender fee, broker fee, what's called interest reserve that they can potentially deduct from the loan. And that's the first chunk of the loan, enough to pay off the first mortgage and cover these costs. Whatever is left becomes part 2 of the loan. And part 2 of the loan is to fund the construction itself. And we've got a construction that is going to cost us $300,000 here. And the way it's set up is as construction draws. So there are lenders that will give you money in hand to kickstart the project. And there are lenders that will require you to kickstart the project yourself. So you've got skin in the game before they start to give you money back. So you got to pay attention to what type of lender you're working with. Ideally for you as an investor, you want somebody to be able to give you money to kickstart the project. But that's how a construction loan is set up. There is also another thing I want you to be aware of. Let's say you have spent $100,000 to get the project going. And now you're going to the lender to get $100,000 drop. You've got a proof that you've spent that money. The appraiser has shown the lender that you've spent that type of money. The lender is not going to give you the full $100,000 back. They're going to hold back 10% of that $100,000 under a rule to protect contractors. It's a construction lien. So for every dollar you're asking the lender to give you to fund your construction, they're holding back 10% of that dollar until you're done with the project. That money will come back to you, but they're holding it because, there are provincial acts, construction acts to protect contractors. So when you run your numbers, it's really important to account for all of the things we talked about. You want to account for the interest on the loan. You want to discuss with the lender or the broker whether that interest is going to be deducted upfront, or it's possible to deduct a percentage of it or maybe potentially pay on a monthly basis, because when it's not all deducted upfront, it keeps more money in your hand as a real estate investor. You want to talk about the lender fees. You want to talk about the broker fees. You want to understand what percentage of this $300,000 at the end of the day is going to be financed for you. As we talked, there are two components of the loan. And yes, you have to pay off the first mortgage on the property. All right. These loans typically don't go behind the first mortgage. So that's also a drawback of these loans, because you have to pay the first mortgage upfront in order to set up construction loans. And as a guiding principle for you as a real estate investor, regardless of whether actually you're going to do a construction loan or not, upfront you want to do an as-is appraisal and an as-complete appraisal. You want to hire a third-party appraisal company upfront to confirm what the value of this property is going to be once you've completed the work. When you're working with a construction lender, they're going to request this anyway, and the appraiser has to be on their approved list of appraisers. But when you're financing the project with your line of credit or a private loan, you want to do it for your own benefit. You want to understand which lender you will ultimately work with once the project is complete to get a refinance done, and ideally order the as-complete appraisal with an appraisal company that is approved by that lender. Your mortgage broker would be able to advise you on that front. So that's it, folks. These are the 4 options to finance the build. Secured line of credit on the property you've got, or a combination of secured line of credits on the property as well as on your portfolio, a private mortgage, or a construction loan. Let's talk about how you can finance the build of an ADU, a garden suite, or a laneway home for a new property that you're looking to acquire. Let's say you found a great property with a great lot, and you can build 1 or 2 or 3 residential units here to densify the site. How do you finance the purchase, and how do you finance the build? When it comes to the purchase itself, it all depends on 2 things. 1, the condition of the current property, and then 2, whether or not you are ready to start the construction right away. If you're not ready to start the construction and you're just looking to acquire the property, and then at some point down the road look at construction and build options, then I suggest that you seek traditional bank financing on the property as long as the house is livable. It could be dated, but livable. So in this case, you would put a 20% down, and we can go and get bank financing at 80% of the value. Now, here is a trap that investors fall into that I want you to avoid. You want to keep your options open here. You want to take a variable rate mortgage, not a fixed rate mortgage. Why? It's because once you add the additional unit or units on the site, the value of the real estate is going to go up. And you would want to tap into that value through a refinance once everything is stabilized. Keeping your options open through a variable rate allows you to switch lenders if you have to go somewhere else to get the refinance done. And with a variable rate, we know that the penalty is a 3-month interest penalty. Therefore, don't lock the term into a fixed rate term, even if the interest is lower, because if you have to break it, it's going to cost you a lot more. Also, I want to give you an important tip here that will save you money. There are mortgages on the street that allow you to go back to the same lender to top up the loan. So if we got a first mortgage here with a lender and the value has increased, that type of a mortgage would give you the option to go back to the same lender and just top up the loan without breaking the existing mortgage that is in place. So you're essentially setting up a parallel loan. That's an ideal path because then you're not touching the first mortgage. There are no penalties involved. That lender already knows the property. So going into the deal, we have to be strategic about which lender we go to. We have to make sure our options give us flexibility and plan it out. You don't want to be in a situation where you're assuming you will be able to go back to the lender to top up the loan and they say, no, we're not ready to give you money on the increased value. There are lenders that will not refinance right away. There are also lenders that will not even consider the higher value as a result of adding that unit. So we have to plan this out going into the deal. But to acquire the site, if you want to just acquire it and sit on it until you're ready to build, that would be the path. And then in terms of your build options, refer to my 4 financing strategies that I talked about to finance the build under a property that you own, because now you own it. So what are these options? Getting a secured line of credit on the property itself, potentially, depending on the timing and whether there is enough equity there, looking at the rest of your portfolio for getting, additional lines of credit and together being able to fund the build. The third option is private money, as I talked about. And then lastly is construction financing. And as I have mentioned, with construction financing, refer to the scenario that I've shared earlier. Construction financing comes in, pays off the existing mortgage, and gives you money to also build. And that's another reason to why you should keep your options open with a variable rate mortgage, because paying it off would cost you a 3-month interest penalty versus an interest rate differential. If you know going into a purchase that you will be in a position to build shortly after you close, and that you've got your drawings up front and you are confident in the ability to get a permit for the site, then you may want to consider construction financing from the get-go. A construction loan is going to give you a component to purchase the property, and it's going to give you another component to build the ADU or the laneway or the garden suite. So let's say you are buying this property for $750,000. A construction loan could potentially fund 80% of that $750,000 to purchase the property, and can give you anywhere from 80% to 100% of the construction budget. So let's say it's going to cost you $300,000 to build the ADU. Part of the construction loan will fund this build, and it can range anywhere from 80 to 100%. Again, the construction lenders typically do not want to exceed a percentage of the as complete value. So if you're going to increase the value to, let's say, 1.2 million, many construction lenders want to stay within 75% to 80% of that as complete value. So you're looking at a ceiling of $900,000 total loan under this setup with the majority of the lenders, unless the lender is willing to go a little bit more above that 80%. But if you've got your drawings ready, if you're going to hit the ground running, going with a construction loan from the get-go would be the recommended option to consider. Let's talk about the most critical part of your project, your exit financing. For you as a real estate investor, you've invested the time and money to add one or more units to the property. You've increased the value of the property, and you've also increased the rental income. Now, what you want to do is you want to be able to tap into that increased value, and you want to be able to refinance that property and pay off most, if not all, of the money you invested. You want to lock into a longer term loan at the best terms to help you cash flow well, and you want to be able to take out equity ideally. If you've done things right and if the market is on your side, you want to take out equity effectively and take it on to your next project. But here is where I see investors make a major mistake. Going into the project and running the numbers, investors sometimes think that it is almost guaranteed that once they increase the value, they'll be able to go back to a bank, refinance at 80%, get a mortgage at a decent rate, and at a 30-year amortization and take the money out. Unfortunately, that's not how it works. Because we're talking about residential financing, your situation is unique. You and I may go and build exactly the same thing or own exactly the same property, but because your credit, your income, your deal structure, your unique financial situation is different than mine, we may end up with different loan options once the work is done. In fact, not all lenders will consider the increased value once the project is complete. Not all lenders will consider the rental income once the project is complete. And some lenders may not even lend in that location. So you don't really want to learn about these things later in the game. And what you want to do is you want to work with a qualified income property financing advisor to help you validate your assumptions going into the deal. They will take a look at all of your documents. They will order an as-is appraisal of the property and an as-complete appraisal, validate the value, validate what type of mortgage you're going to be able to get upon completion. This way, you're stepping into the deal knowing, is it going to be 80% once the work is done? Is it going to be a 3% interest rate or a 5% or whatever interest rate? Is it going to be the amortization that you envision? Validate these assumptions going into the deal. And that's where the work needs to get done with respect to exit financing upfront, not after you're done. If you're going to rely on construction financing for building an ADU, a garden suite, or a laneway house, I want you to know that the cost of a construction loan goes way beyond the interest rate alone. And I would like to pull the curtain to show you what are the different costs that you need to be aware of and account for. So the first one is obviously the interest rate. And when it comes to construction loans, these are typically interest-only loans that are based on the prime rate in Canada. At the time of the recording of this video, prime rate is at 4.95%. And we all know that prime rate fluctuates depending on what the Bank of Canada does with interest rates. When it comes to a construction loan, they're priced off prime, and the lenders add a percentage on top of that. So they could be prime plus anywhere from 2% to even 4%. Sometimes they're a little less than 2%, 1.5%. So as of today's video, at a prime rate of 4.95, a typical construction loan can be at 6.95 interest to 8.95 interest. So they're interest-only loans that are based off prime plus a premium. Now, let's talk about the different costs associated with a construction loan. The first cost is the cost of the interest. And for that, the lenders calculate what's called an interest reserve. Essentially, on a construction loan, the lenders want to make sure that they are getting paid while you are building. So you need to understand how interest reserve is going to work for your project and how much that is. So let's look at an example. Let's assume that you are getting a $500,000 construction loan, and the interest rate on that loan at prime plus 2 is 6.95, and that you need this loan for 6 months. If we were to take the loan amount, multiply it by the interest rate over a period of 6 months, you're looking at roughly $17,000 of interest payments. So in this case, the lender may want to take this $17,000 upfront from the money that you're getting. So essentially, at the lawyer's office, you're getting $500 minus the $17,000 because the lender is getting to hold on to their interest upfront. Some lenders do that. Some lenders may say, we're not going to take it all. We will take just a percentage. And some lenders will let you pay that interest on a monthly basis, but they have to be comfortable with any rental income that is coming in or your ability to pay the interest for them not to deduct the interest reserve. The more of this you keep in your pocket, meaning the less interest reserve the lender takes upfront, the more you have in your hands as an investor to complete your project. So depends on what type of lender you're working with. They all follow the same type of thinking about interest reserve, but they vary in whether or not they're going to take it all up front or take a percentage of it or let you pay monthly. The second cost that you need to be aware of is construction draw fees. Let's say building the ADU is going to cost you $300,000 and the construction lender is willing to finance 80% of that $300,000. Let's talk about the second cost item, which is construction draw fees. Let's say that it's going to cost you $300,000 to build an ADU, and the construction lender is willing to give you 80% of that $300,000 to fund your project. So we're talking about $240,000 to fund the construction. The difference between the 300 and the 240 would be your injection of capital into the deal. How do construction draws work? First of all, the lender is not going to give you the entire $240,000 to start building. Some lenders want to see that you are kicking the project off with your own money. So you go in and spend, let's say, $50,000 or $100,000, and then you go back to the lender, ask them to give you that money back. Some lenders want to see that you have skin in the game, and some lenders are okay giving you a percentage of the money to kickstart the project. So there are, again, different approaches here, but the principle of a construction draw is essentially the same. You're going to the lender to ask to get a percentage of what they approved the loan for to keep your project going. So let's say you're going to the lender to ask for $100,000 of this $240,000. Some lenders will charge what's called a draw fee. So when you look at the mortgage commitment, pay attention to what that draw fee is. Sometimes it's expensive, so pay attention to it. The other thing I want you to be aware of is that although you're asking to get a $100,000 draw because you've spent the $100,000, the lenders are going to hold back a 10% of that $100,000. Depending on which province you're in, there are regulations around the Construction Act, and the lender has to keep 10% of the money in trust to comply with that. Now, you're not losing that money. Once your project is complete and is in occupancy, you will get that money back that the lender held back on. But from a cash at hand standpoint, we want to plan for it, because I don't want you to assume that you're going to get the entire $100,000. There will be money that the lender will keep in their back pocket until your project is done, and then they're going to release it back to you. So we have to take that into account. The third cost associated with a construction loan is the progress report cost. The lender essentially wants to ensure that what you said you've spent money on has been. The third cost associated with a construction loan is the progress report cost. The lender essentially wants to ensure that what you said you've spent money on is accurate. So there are lenders that will just ask you for invoices of what you've spent money on. And there are lenders that will ask for the invoices, but also have an appraiser go and visit the site to confirm the progress that you've made. And when that is part of the process, it's going to cost you extra money, because there is somebody checking the work. And that's what the progress report costs are all about. So pay attention to that. Okay, I'm doing a repeat of the progress report section. So discard what I've said earlier. The third cost associated with a construction loan is the cost of a progress report. Essentially, the lender wants to make sure that what you said you've spent money on is accurate. And by confirming that, they can then release the next draw that you're requesting. Lenders will ask for invoices, but in many cases, they have an appraiser visit to confirm that the work has been done according to the plan and according to what you've spent on. So there is a cost that comes with that, and I want you to be aware of it. The cost varies from one lender to another, but it's another cost to account for. The fourth cost is lender fees. Lender fees are essentially a percentage of the total loan amount you are requesting. Lender fees on construction loans range anywhere from 2 to 4% on the higher side, but sometimes you're able to get a lender fee below 2% at 1.5% if that lender knows you really, really well. Sometimes it's above 4%, but this is the general band, 2 to 4% on the higher side as a percentage of the loan amount. The lender fees are deducted upfront from the loan. So if you're getting a loan, let's say for $500,000 and the lender fee is 2%, that is $10,000. In reality, you're gonna get a check off the loan minus that $10,000. That's how the lenders set up their fees. Mortgage brokers often charge also a broker fee on construction loans. That fee ranges from one broker to another broker. It can be anywhere from 1% to 4% on the really, really higher side, but generally it's closer to 1 and 2%. And again, it's a percentage of the loan. That is money that you have to come up with at the time of closing to cover the broker fee. But it's a cost that you need to account for and inquire about. Your mortgage broker will disclose to you any broker fees that they will be charging. And the earlier they talk to you about this, the better. So there are no surprises to you later down the road. The fifth cost category associated with a construction loan relates to renewal fees. If your project goes above its extended timeline, you will hit the renewal, and the lender that holds the construction loan may or may not renew. There is actually no guarantee. So you'll always want to obviously stick with your plan and timelines. But despite all good intentions, construction goes sometimes above the intended timeline. So pay attention upfront to your renewal terms and your renewal fees. Some lenders charge not only a renewal fee, but they charge a new lender fee altogether at the time of renewal. Account for that in your projections as part of the worst case scenario. I want to talk about something called a floor rate. A floor rate is a term that you will likely see with construction loans. And what it is essentially is a floor or an interest rate that the lender will set as part of your mortgage approval. And regardless of whether or not the actual interest rate in the market changes. Okay, this is a redo of the floor rate segment. I'd like to share with you an important, aside from the costs that come with a construction loan, I would like you to be aware of a concept that is called the floor rate. When it comes to construction loans, you will often see this term in the mortgage approval. And what it is essentially is the lender setting up a minimum interest rate that they will charge you regardless of what happens with the actual interest rate in the market. So remember we talked about interest rates on construction loans based on Prime Plus. As of the time of this recording, Prime is at 4.95, and let's say the construction loan is at Prime plus 3, so that would give us a 7.95%. Typically what happens is the lender would set it up at 7.95%. And if the Bank of Canada reduces Prime from 4.95 to something else, let's say they've cut it down, the lender will still charge you that 7.95. Your interest rate on a construction loan will not go down. But if the Bank of Canada increases Prime, then your loan cost will go up. So some investors say, why am I not benefiting when the Bank of Canada reduces the rate? That's a great question. On a typical variable rate, when you have a house and you've got a bank loan at a variable rate, you would benefit. Your monthly payment may go down, or your cost overall would go down. But on a construction loan, that's something that's done differently, where the lenders have a floor rate and your loan will not float as the interest rate goes down. So you need to also be aware of that. Ultimately, as a real estate investor, you want to account for all costs, including acquisition costs, financing costs, holding costs, and weigh that against your expected returns from creating an ADU, a laneway house, or a garden suite. You want to make sure that you are recouping as much as you can out of the costs, and also you're reducing these costs as much as possible while you're building. So here you have it. Financing an ADU, a garden suite, or a laneway house is a multi-step process. But with the right knowledge and the right plan, it is absolutely achievable. You want to go into the deal understanding your loan options, understanding all of the costs involved, and understanding your exit strategy. And that's what we do here at Streetwise Mortgages. We help real estate investors connect the dots when it comes to financing ADUs. If you are serious about building an ADU or a laneway house or a garden suite and you want to move from planning to action, the next logical step is to develop your financing strategy. I invite you to meet with one of my team members for a one-on-one complimentary deep dive into your project, where we're going to help you connect the dots. Here's specifically what we're going to look at in that session. We're going to help you explore all of the money sources available to you, and we will guide you as to which source would work best for you. And if you have somebody like a partner involved in your deal, we can also guide you as to how to structure the deal with them from a financing standpoint. So first step is aligning your money sources. Second step is helping you structure the deal. And we want to know if it's best to set up a line of credit, a private loan, or a construction loan. We also want to help you map up all of the costs involved so you can validate your assumptions around the return on your investment. And most importantly, we want to help you validate your exit strategy. We want to make sure that you will succeed by the end of the build, that you'll be able to take the money out, that you'll be able to get a great mortgage so that you cash flow, that you are not stuck with private money or construction financing, and you're able to clear that out. So completely complimentary. We'd love to support you. Reach out to our qualified income property financing advisors to go through the session, and the details of how you can connect are in the description of this video. If you enjoyed this video or learned something you didn't know before about financing ADUs and garden suites and laneway houses, I invite you to hit the bell button to stay informed of our future videos and to subscribe. I look forward to seeing you in our next episode.